You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy New Year, everyone. As a quick reminder, in case you missed the final episode of 2021, we're going to be changing up the podcast next year, I should say this year, and instead of sending out one every single week, we're going to be changing the frequency to a bi-weekly schedule. Again, if you missed it, the reason for this is because we've received a lot of feedback from people who say that they'd like to see more articles and written material, which, ironically enough, we used to do a ton more written material before the pandemic began back in 2020. And a lot less in terms of videos and podcasts, and that kind of got flipped upside down when the pandemic began. So we're trying to balance it out a little bit here, and the goal is going to be to shoot one podcast episode every other week, and then I'm going to be writing a Coach's Corner article every other week as well. So if you're a podcast subscriber and you want to receive these articles, be sure to head over to our website at libertaswealth.com and subscribe on our website, and they'll hit your email inbox whenever we publish them. Speaking of, we have just recently received somebody contact. In fact, just recently somebody contacted us. Speaking of, somebody recently just contacted us and said that they weren't receiving our emails and hadn't been receiving the notifications for any of our materials. So if that ever happens to you, two things: obviously, check your junk email, your spam filter. In fact, there was more than once just recently. In one of the situations, all of our emails were going into the spam filter, and in the other situation, it was kind of ironic, but the individual in question accidentally unsubscribed to all of our materials. So in that case, they had to resubscribe themselves. We can't turn it back on. So if you're sick of hearing from us, you can always unsubscribe. But if you do by accident unsubscribe, you can always resubscribe. So anyway, back to today's podcast. And for the first podcast of 2022, we're going to be talking about stock market seasonality and how to use those trends, or how those trends can act as a guide when looking ahead at the new year. But before we get started, as always, first off, thank you so much for joining us. My hope is you learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and above all, more educated than you were before you started listening today. So come back often, subscribe. These episodes appear both on iTunes and YouTube. And you can also follow me on Twitter at Adam Koch and on Instagram at Financial Surgeon. Last but not least, all links, visuals, charts, and additional educational resources are always available on our website. And if you're looking to view the charts that I'm going to be talking about today, you can always check it out on our YouTube channel, where the podcast is in visual form. You can rewind, fast forward, pause, and so on and so forth. So let's go ahead and get started. As always, a quote of the day. And for the first one of 2022, the quote is Dr. Jill Murray. She's an author, speaker, therapist. And she said, "The comeback is always greater than the setback." And I think that's especially applicable in today's market because the market has been pretty much struggling for the last few months, especially into the new year. But the interesting thing is that this is kind of expected for a midterm election year, and we're going to talk about that a little bit later. But as is expected for the market to struggle in the beginning of the year during a midterm election year, it's also expected for it to do well for the back part of the year. And hence, the comeback is always greater than the setback. So right now, what we're going to be living through, or at least from a seasonal historical standpoint, is we are living through the setback, which there's nothing wrong with that. We want to keep our eyes on the long term, not the short term. We don't want to let, a few weeks or a few months or even half a year get us in the way of our long-term goals. So, and I know that's a lot easier said than done, and that's what we're here for, obviously, is to make sure you're staying on track, following your financial plan, retirement plan, watching your savings and withdrawal rates, and making sure that you're sticking to that plan long-term so that you can live a prosperous retirement, never have to go back to work, and so that your money lasts longer than you do. But still, it goes without saying, money's a very emotional thing, and I think that we're probably, just based on seasonal averages alone, we're probably going to continue to see a choppy first half of 2022 for a few reasons, and I'll go over that. But first, Let's talk a little bit about seasonality and what that means. So history can be a guide, as I put in the title, for how we can observe the rest of the year or look at any given year for that matter. And there's a multitude of ways we can observe the stock market using seasonality. One way is looking at semi-annual or half-year major market seasonal trends. Trends like the sell in May and go away, which basically means that the market has a tendency to do very well between October 31st and May 1st. And then from May 1st through Halloween, the market tends to struggle a lot more, historically speaking. Quarterly major market seasonal trends, things like the fact that the fourth quarter has a tendency to be the best quarter of the year for the market. Asset class, sector, industry seasonality. These are a lot more detailed. This is where you can look and see if when does gold typically perform the best throughout the year, or when does natural gas have a tendency to perform the best throughout the year, when do cyclicals perform the best, and so on and so forth. And so you can drill down from asset class, meaning stocks, commodities, bonds, and so on, down into sectors and even minute industry groups and look at seasonality. And the one that we're going to be talking about today is election year seasonality. And there's a lot of ways to break this up, but there's a 4-year election cycle, starting with the post-election year, then the midterm election year, the pre-election year, and the election year. So when we look at all 4 of these years, there's different trends and different seasons or seasonality trends that we can observe. And we can also break it down by whether or not there's a Republican or a Democrat in the office. And we can also break it down by whether or not it's their first or second term in office. So there's, as the saying goes, many ways to skin a cat here. But we're just going to focus on this year being a midterm election year. And a couple things to keep in mind, though, is that seasonality is based on historical averages over time. And historical trends can provide us with what we might expect in the future. But the infinitive word there is might. While history can be a guide, it's not a promise. In fact, one of the most, I don't want to call it interesting, although it is interesting, but one of the most useful ways of using seasonality is when the market doesn't behave like the seasons say it will. That's probably when it's most valuable. So, for instance, if the market is supposed to perform poorly between May 1st and Halloween, but it performs very well, that usually means very good things for the seasonally good months, even though the seasonally good months are typically good anyway, between November 1st and April 30th. If the seasonally bad months do well when they're supposed to be bad, that usually means good things for the season, or especially good things for the seasonally good months. Let's just say we have a seasonally poor months between November 1st and May 1st. That can usually mean a struggle for those months between May 1st and Halloween, however. So, and while those months between May 1st and Halloween are normally a struggle because they're the seasonally poor months, it can mean an especially bad period of time. Again, understanding that these are all averages, they're not promises. So we want to use them as a guide. Looking at January for starters, and this is all the major market indices here. We got the Dow, the Nasdaq, the Russell 2000, which is small caps, the S&P 500, which is large caps, and so on. And you can see here that right around, on average, this is averages by the way, 21 years going back in time since 2001, the market has a tendency to go down, or I should say, in the case of the some indices, they go up first and then they go down, but the market tends to peak on average right around the 11th trading day of the month, and that's trading days, not calendar days, by the way. There's about 21 trading days in every month, and then it has a tendency to go down from there. So the seasonal trend for the month of January is typically down, especially for the last half of the month. In the case of this year so far, we haven't really seen any sort of bounce into the first half of the month at all. What we've seen is the market pretty much opened the beginning of the year and continued going down, which is kind of a lot of what we saw toward the tail end of last year as well. Along those same lines, when we look at the top 50 growth stocks in the country, so this is the IBD, Investors Business Daily, top 50 growth stocks in the U.S., what we're looking at here is the last 12 months. And over the last 12 months, these stocks are down on average 9.6%. This is an ETF. It's a basket of stocks. Again, Investors Business Daily puts together a list. They consider these the top 50 growth stocks. And like I said, over the last 12 months, they're down about 9.6%. And then when you look at it since their highs, which you could say, when I looked at this and I charted it, the high was actually in September, but you could look at it since November as well. It doesn't really matter. And since its highs in September and November, it's down 22%. So even the top 50 growth stocks have obviously been struggling recently. Changing gears when we look at some of the good stocks. So this is some of the stuff that did well last year, and even though a lot of the big, huge mega caps were as I called it in our market outlook screencast this year, the tail that wagged the dog in 2021, there's a handful of huge growth stocks that did very well. Google being one of those stocks, which is down off its November highs. It's down almost 10%. So we're seeing that a continuation of that decline here into January. Which, again, these were some of the relatively strongest stocks. When we look at Microsoft, another one of those big, huge mega cap stocks that has been a leader, even these leaders, these stocks that have been good recently, have been struggling. Microsoft being down about 11 to 12% just off its November highs. Looking at Netflix, another one of the largest stocks in the S&P 500, which again was kind of choppy through the vast majority of the first 9 months of 2021, but then had a nice kind of run in the third quarter. Since November's down over 20%. So Netflix obviously being a drag on the market when normally it had kind of helped in the third quarter anyway last year. And then even when we look at bonds. Even bonds have been a struggle. And if you didn't watch our 2022 Market Outlook screencast on our other channel, this is the Libertas channel. Obviously, this is the podcast channel. We did a big Market Outlook like we do every year. And one of the things I pointed out was that bonds were down for the fourth time only. So for the fourth time in 40 years, I believe it was 40 or 45 years. And that's obviously when you look at your bonds in your portfolio, if you're somebody who's not aggressive, so if you're somebody who's a moderate investor, then you're typically going to have some bonds in your portfolio. If you're a balanced investor, then you're probably going to have even more bonds in your portfolio. Maybe it's going to look like a 60-40 mix, stocks, bonds. If you're a conservative investor, you're probably going to be overweighted in bonds. And that's one of those things when we look at last year, normally we see bonds helping us when the market isn't doing well, where instead bonds actually acted as a drag on performance. Being more diversified in bonds hurt us, in other words. And so far this year, that's just continued as interest rates have gone up, bonds have continued to go down, and we've wanted to underweight bonds going forward, at least for the time being, in order to avoid the drag on performance that these bonds can create. But when you look back here, what I'm looking at here on my screen for those of you listening on iTunes is a chart of the AGG, which is the iShares U.S. Aggregate Bond ETF. It's basically a good representation of what the overall bond market in the U.S. has done. And looking back 12 months, it's down almost 6%, 5.6% today to be exact at the time of my recording, which was, I think I pulled this chart around 12:30 or so. Oh, actually it says right on 1:48 p.m. is when I pulled it. So anyway, point being, even bonds have been a struggle so far this year. As stocks seasonally, we can expect stocks to not do so well in January, especially the last half of January. And then when we look at what's doing well, one of the things that are doing well are commodities. Why are commodities doing well? Well, I'm sure those listening probably have noticed there's been some inflation in this country. There's some debate out there as to whether or not that inflation has a lot to do with the supply chain, whether it's temporary, and when the supply chain starts to ease up and catch up, whether or not we'll start to see inflation calm down. And I guess we'll just kind of have to see what happens. Nobody knows for sure. So as inflation has gone up, so have commodities, because when you're in an inflationary environment, commodities have a tendency to do well. Now, if we change gears here and we look at the big picture, if we look out into the future, or technically we're looking back into the past, we can look at the average, first and foremost, the average rate of return or the average performance of the stock market going back to 1946. So the average return of the stock market going back to 1946 has been almost 9% per year. And this is obviously a really, really, really long-term time period. And when you look at those averages, the market has a tendency in any given year to do well right up until about May. So you remember that sell in May and go away. And then between May and October, it really only goes up about not even a 1%, or at least close to it. You could even argue that it doesn't really start to make any movements until the end of October. So most of the market's return on average since 1946 has come during the months of January and May, and then to call it toward the end of October and the end of the year. Now that's all years. Now what we want to change our focus to today is focusing on the year we're living in, which is a midterm election year. Now, without getting into too many details, what I want to focus on is just all midterm election years in general. And what you tend to see during midterm election years is the market goes down on average since 1946. The average midterm election year, we see the market go down from January through about the first week in February. After that, we see the market kind of head northward from the beginning of February through about the middle of April, maybe a little bit past the middle of April. After that, we have a tendency to see that whole sell in May and go away thing take form, where the market goes down from mid to late April down until about the beginning of, or end of June, beginning of July, we'll call it. And then from there, the market just has a tendency to go nowhere. This is the S&P 500, by the way. So the market has a tendency to go nowhere from pretty much the end of June through the beginning of October, at which point we start to see the market shoot northward once we have a clearer picture of what's going on with the midterm elections, because the market doesn't like uncertainty. I mean, at the end of the day here, the market wants to know what's going on, and this year, in a midterm election year, we don't know who's going to control Congress or Senate. We don't really know what's going to happen with rates, obviously. We know they're probably going to go up. We know the Fed's probably going to increase rates. We don't exactly know what's going on with inflation. But when you look at typical midterm election years, the market likes certainty. So what happens is during that first part of the year, we'll call it the first 6 to 9 months of the year, the market has a tendency to pretty much be choppy. It goes up, it goes down, but generally flat at the end of the day, right up until about October. And then we see the majority of the market's gains come at the end of the year. And what that tells me, and what it should tell you, is that 2022 is going to probably be a year, even though this isn't a promise. Things could be better, right? They could be worse, of course. But what the history is telling us is that 2022 is going to be a year that's going to require us to be very patient. So for the first at least 8 to 9 months of the year, I would say we're going to have to be really, really patient, focus on spending time with our family, try to avoid the financial news and worrying about whatever happens to your retirement account this month or this quarter or what have you, and really try to focus on the long term. And here's another reason why. This is my friend Ryan Dietrich. He did this research, and what he found was going back to 1950. When we look at midterm election years, we tend to see a larger pullback or correction in the market than what's typical in any other year. So the intra-year pullbacks are typically bigger on average. We can go and say, well, the worst one was 1974 at 37.6%. That's a market crash. That's not a pullback, obviously. But there's ones as small as 4.4% in 1954 and 1958. But if we average them out and we look back in time, going back to 1950, at every midterm election year, at all the intra-year pullbacks, what we end up with is an average of 17.1%, or a median, if you care about the statistics. Median is 16.3, so we'll call it 16 to 17% is the average intra-year pullback. But then the return for the S&P 500 from the bottom, so this is not the annual return for the calendar year, but the return off the bottom of that intra-year pullback or market correction is an average of 32.3% or 33.5% if you're looking at the median. So what that tells us is that while we can typically see a bigger intra-year pullback during midterm election years than normal, and than a normal year, we also have a tendency to see really, really great returns a year thereafter. So again, I think that goes back to that topic of patience, or that lesson that we need to, in 2022, we're probably going to have to exhibit or practice a lot of patience throughout most of the year as the market continues to be probably a little bit more frustrating than normal, I would say. Now, there's several fundamental reasons why we could potentially find ourselves nervous or worried about what's going to happen throughout the rest of this year. One that's popped up that I keep seeing recently when I'm doing my reading is the 200,000 Russian troops sitting at the Ukrainian border. There's always geopolitical events, things like this that could happen that could cause a shock to the market, news-driven events. The bad news obviously about news-driven events is that usually there's something bad happening. The good news about news-driven events, if there's going to be any good news, is that they tend to be pretty short-lived. They don't typically find themselves being drawn out, or result in long, drawn-out market corrections or crashes, for that matter. We also have inflation. We talked about that a little bit today. Supply chain disruption that we've seen or experienced this last couple of years. We see interest rates going up really fast. We see just recently, I believe it was last week on Thursday or Friday, mortgage rates hit their highest rate since early 2020. So we're starting to see the short-term treasuries, 10-year treasuries, we're starting to see these treasuries go up, which is the reason why bonds are struggling so much. And then we also have Fed tapering. We don't know. We know that the Fed has said they're going to increase rates 3 times this year. We don't know any of the other things they're going to do or not do, for that matter. So that remains to be seen, and that's a factor, obviously. So these are all fundamental reasons why we could worry and get concerned about this year. But haven't we seen worries like this before? I don't have. Maybe what I'll do next time in our next podcast is we'll talk about climbing the wall of worry. I've mentioned before that the market has a tendency to take the escalator up and the elevator down. So, but the market does climb a wall of worries. There's almost always something to worry about every single month, every week, every day, for that matter, when it comes to the stock market, the bond market, the commodity market, and your portfolio, your retirement portfolio. But we've seen these worries before. And the 3 things that we need to focus on, none of which are any of these things we need to worry about, but the 3 things we need to focus on are A, our financial plan, and making sure that we're saving. That's number 2, making sure we're saving and or spending what we're supposed to, or supplemental income from our retirement plan. That's for those of us who are not retired. We'll focus on our saving. If we're already retired, we need to focus on our withdrawal rate. And then third, we need to focus on the long term. I always say focus on the horizon and not your feet. And the reason for that is because the number one reason why individuals and couples retirement plans fail. So the number one reason why retirement plans fail is because the individual or couple in question abandoned the plan. And the number one reason why individuals and couples have a tendency to abandon their retirement plan is because the short-term volatility of the market, like for instance this year, if all we do is meet the averages and the average drawdown this year, intra-year, is 16 to 17% off the top, then I think that short-term volatility has a tendency to freak people out. Justifiably so, by the way. Seeing in a short period of time, which can be defined as 1 month or 6 months or 8 months, I mean, that's still short. I think that when people see their retirement accounts decline in value in the short term, that can really cause concern. However, in the long term, when we focus on that horizon and not our feet, I think what we find is that we're betting on the U.S. economy. We're betting on our economy not going to zero, for that matter. And I think that the future is a lot brighter than we realize, especially if we look back at history and we see all the things that we've been through. Even for those of us right now in our retirement years, from the first day that we put our first dollar into our 401k or 403b or pension plan at work until now, we've been through a lot. There's a lot that's happened. There's a lot of reasons for people to have said, you know what, I'm done. I'm putting all this money in the bank. I'm buying CDs, or I'm buying fixed annuities, or I'm putting it in guaranteed investments. There's a lot of reasons over the last 20, 30 years, if not longer, 50 years, for one to have made that decision just out of pure fear. But as the saying goes, fear is an acronym, right? FEAR, false expectations appearing real. And I think that what we're going to find this year at the end of the day is we're going to have a choppy market, I'm guessing. Again, no promises here, but we'll probably have a choppy market that goes up and down, but generally with a downward bias, easy for me to say, a downward bias through the first half to 8 to 9 months of the year. And once we have a clearer picture of what's going to happen with the midterm elections, once the Fed tapering is pretty much behind us at that point, and once we know a lot more about what's going on with inflation and the supply chain, I think that we'll have a whole lot more room for clarity for this market to head northward again. So with that all being said, I think we will close the podcast out for the day. Be sure to share this episode with your friends and family if you think they would benefit, and if you'd like to discuss your personal financial situation further in more detail. Remember that you never ever have to be a client to ask a question. So if you'd like to set up an intro call with me, email us at info@libertaswealth.com or head over to our website on our contact page at libertaswealth.com. You can be the first to watch and or listen to these episodes by subscribing both on iTunes and YouTube. And don't forget, if you head over to libertaswealth.com, you can sign up to get not only these updates, but also all of our other screencasts, videos, and articles delivered directly to your email inbox whenever they're released. Feel free to follow us on Facebook at facebook.com/LibertasWealth. I'm also on Twitter at Adam Koch and Instagram at Financial Surgeon. And as I always say, there are thousands and thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.